Right now, as we watch the market pulse on this Monday, November 24, 2025, Supermicro Inc., ticker symbol SMCI, is trading at exactly 32.56 USD. That is a green move of positive 0.37 cents, translating to a 1.14% gain on the intraday session so far. If you were just glancing at that green percentage on your screen, you might be tempted to think this is a standard recovery day or a quiet accumulation phase for the server manufacturer. You would be wrong. The reality of this price action is far more complex and far more dangerous than a simple 1% tick suggests. We are seeing a stock that is currently sitting at the epicenter of a massive tug of war between deep-value institutional beliefs and a lingering fear that has haunted this company for the better part of 18 months. While the broader indices are trying to find their footing, SMCI is moving with a specific kind of nervousness that usually precedes a major break, either to the upside or a catastrophic flush to the downside. The expectation from the retail crowd, especially those discussing it on forums or checking their Robinhood app, is that SMCI is simply a cheap NVIDIA play, a discount ticket to the artificial intelligence hardware boom that has defined this decade. They see the price at $32 and compare it to the triple-digit highs of the past, assuming it is an automatic bargain. The reality, however, challenges that assumption aggressively. The market is not discounting this stock because it forgot about AI. The market is discounting it because the trust premium has evaporated. What we are witnessing today at the 32.56 level is not just a valuation of future cash flows, but a real-time pricing of legal and accounting risk. Following the massive volatility we saw late last year and the frantic auditor shuffle that saw BDO USA step in after the previous auditor resigned, every single tick on this chart is scrutinized for signs of stability that have yet to fully materialize. When you look at the volume today, it is relatively muted compared to the explosive sell-off days we saw earlier in November when billionaire Philippe Laffont unloaded shares, signaling a loss of confidence from the smart money. That exit was a brutal wake-up call. It told us that even those with the deepest research teams were opting to take their capital elsewhere, perhaps rotating into more stable compounders like Apple stock, or even taking a position in Tesla stock, which has its own volatility but lacks the existential accounting dread that currently hangs over Supermicro. However, there is a counter-narrative forming right now, in this very session, which explains why we are holding green at 1.14% up. Just a few days ago, on November 20th, the company unveiled its new 10U air-cooled server featuring the AMD Instinct MI355X GPUs. This is a critical development that many bears are ignoring. The expectation was that Supermicro was so bogged down in compliance issues that their engineering engine had stalled. The reality is that the engineering team is still shipping iron. They are still pushing out cutting-edge hardware that data centers desperately need. This creates a fascinating divergence. The corporate suit and tie side of the business is fighting for compliance and trust, while the engineering side is still punching heavily in the weight class of Dell and HP. This divergence is what makes the stock so incredibly addictive to watch and so dangerous to trade. If you are sitting there managing your own capital, perhaps using a platform like interactive brokerage trading to execute fast orders, you know that low-volume green days like today can be deceptive traps. Interactive Brokers platform data often shows us the depth of the order book, and right now the bid support at $32 is thin. It would not take much selling pressure to crack this level. Conversely, if you are a long-term investor using Fidelity investments for your retirement accounts, you're looking at this through a completely different lens. You're asking if the company will exist in 5 years. Fidelity Wealth Management advisors often caution against catching falling knives, yet the sheer revenue potential of Supermicro keeps it on the watch list. The company is generating billions in sales. The demand for liquid cooling, which is their specialty, is not going away. In fact, as chips get hotter and power density in racks increases, liquid cooling becomes non-negotiable. This is the fundamental floor that is keeping the stock from going to zero, even as the accounting clouds refuse to clear. This brings us to the broader landscape of how individual investors are handling this name. We're seeing a massive split in behavior. On one side, you have the passive crowd, perhaps those utilizing Schwab Intelligent portfolios or similar robo-advisor services. These algorithms are largely avoiding SMCI right now because the volatility metrics violate the safety parameters of a standard intelligent portfolio. They are programmed to seek risk-adjusted returns, and currently the risk denominator for Supermicro is too high. On the other hand, you have the active traders, the ones engaging in online investing through mobile-first brokerages. They're treating SMCI almost like a leverage option on the entire AI sector. If NVIDIA stock has a good day, they buy SMCI, hoping for a sympathy bounce. If the sector lags, they dump it. This creates a correlation that is not based on Supermicro's actual business performance, but on its status as a high beta proxy for the industry. Comment below how many shares of Supermicro Computer you currently hold and what your average buy-in price is. I want to see if the majority of you are averaging down or waiting for a breakout. When we zoom out and look at the chart patterns forming this month, specifically the symmetrical triangle that some technical analysts pointed out in mid-November, we see that the price is coiling. A coiling price combined with the fundamental uncertainty of the annual report delays creates a pressure cooker. The company has fought hard to regain NASDAQ compliance, and the extension granted earlier was a lifeline. But lifelines don't last forever. The market is waiting for a clean quarter. A quarter where the earnings report comes out on time, the auditor signs off without a qualified opinion, and the guidance is purely about demand, not legal fees. Until that happens, every rally, including the 0.37-cent gain we see today, is suspect. Let's talk about the business model itself, because it's easy to get lost in the stock drama and forget what they actually build. Supermicro is often described as the Lego of the server world. Unlike their competitors who build rigid proprietary systems, Supermicro uses a building block architecture. This allows them to spin up new server designs incredibly fast. When NVIDIA or AMD releases a new chip, Supermicro is often the first to market with a rack that supports it because they just need to swap out the relevant modules rather than redesigning the entire chassis. This time-to-market advantage was their primary moat for the last decade. It's why they grew so fast. But that same speed and loose structure in engineering might have bled into their financial controls. The expectation was that a company generating this much revenue would have the internal controls of a mature S&P 500 component. The reality revealed over the last year was that their internal finance team was struggling to keep up with the velocity of their sales. This is a classic growing pains story gone wrong. For those of you who engage in self-investing and use investment help tools provided by platforms like SoFi Invest, you have likely seen the strong sell or hold ratings plastered on this stock. SoFi investing dashboards often aggregate analyst sentiment, and the sentiment right now is one of extreme caution. But here's the contrarian take that forces us to rethink the bear case. What if the worst is already priced in? The stock is down significantly from its all-time highs. The bad news about the auditor resignation is known. The delay in filings is known. The DOJ inquiries are known. In the stock market, known bad news is often less damaging than unknown bad news. If the company manages to file its 10K and 10Q forms and simply survives, the repricing could be violent to the upside. This is the binary bet that allows aggressive traders on the Robinhood app to sleep at night holding this bag. They're betting on survival, not perfection. We also need to consider the macroeconomic pressures weighing on the stock today. The 10-year Treasury yield is fluctuating, and general tech sentiment is fragile. When rates stay high, capital-intensive businesses like server manufacturing face headwinds because their clients, the data centers, find it more expensive to borrow money to buy these racks. Supermicro sells expensive kit. A fully loaded AI rack can cost millions of dollars. If their customers are seeing their cost of capital rise, orders might